The American Society of Appraisers describes the income approach as a general way of determining a value indication of a business, business ownership interest, security, or intangible asset by using one or more methods through which anticipated benefits are converted into value. The income approach is a widely used way to value a business interest and is essential when valuing a going concern. BVS helps you select the appropriate benefit stream, develop discount and cap rates, and properly apply all of the key variables. The valuation methods included in the income approach are discounted future earnings, discounted cash flow, capitalization of earnings, capitalization of excess earnings, and multiple of discretionary earnings. First, a quick refresher. All of the work that you've previously done in normalizing historic financial data and preparing projections is organized and summarized at the beginning of the valuation section. This is the information base. These multi-views avoid what we call menu jumps or tab surfing for Excel spreadsheet users. BVS puts key data at your fingertips. When applying the income approach methods, the key factors are selecting the appropriate benefit streams, defining the parameters for calculations, such as discounting convention, terminal value option, etc., developing discount and cap rates, and applying the appropriate rate to the selected benefit streams and converting the result to an indicated equity value. BVS gives you the calculation power, but more importantly, the flexibility to control and properly apply the assumptions that go into each method under the income approach. Let's take a quick look at the actual schedules, starting with the discounted cash flow and earnings schedules, and then we'll look at the control panel where you control and select the assumptions that go into these methods. This is the discounted future earnings. The selected benefit stream is earnings before interest, taxes, depreciation, and amortization, or EBITDA. EBITDA is a debt-free or unlevered benefit stream, so the discount rate is also the debt-free rate. The application of the debt-free rate to the debt-free benefit stream results in a debt-free value or total invested capital value that's converted to an equity value. This is the discounted equity net cash flow schedule. As the name implies, the benefit in this method is always equity net cash flows, and it uses an equity or levered discount rate. The current example assumes a full year, 12 months of projected earnings or cash flow. But what happens when you have a partial projected year because the valuation falls in the middle of a year? Sound theory says that when applying discounted future benefit streams, that you do not mix or include historic benefits. That's the benefit stream in the interim financials. When a partial year is involved, BVS will only include the partial year projected benefit stream, not the full year. And now this is often overlooked. BVS will adjust the present value factor that's applied to the earnings for a given projected year. This is the capitalization of earnings schedule. In the example, the selected benefit stream is EBITDA, and the example gives equal weight to each year. EBITDA is a debt-free benefit stream, and therefore the debt-free capitalization rate is being applied. The presentation is rather straightforward and easy to follow. The key to this simplicity resides in the panels that control the various assumptions that feed into these schedules. Now let's review how these panels work to give you the flexibility and control you need to set the assumptions, and most importantly, set assumptions in a way that properly matches benefit streams with the appropriate discount and capitalization rates. You might recall seeing this benefit stream control panel in the prior video overview of the valuation section. This is from the valuation setup, and it lays out a three-step process for selecting benefit stream assumptions. Under step 1, you select either an equity-based or debt-free benefit stream, and if using a debt-free one, you can select whether the discount and capitalization rates will be based upon the existing or an alternative capital structure. Under step 2, you apply weights to the historic benefit streams if applicable. You can have separate weights for earnings and cash flows because historic cash flows have one less year. Under step 3, you also have flexible options for the earnings time frame to use in the income approach. Notice that BVS shows you the historic earnings amount as you make your selection, so you can see the dollar values and you're not making your selections blindly. Now the stage is set for you to move on to the income approach control panel. Here's where we set the parameters for calculations and develop the risk rates. BVS harnesses all of the different parameters in the 6 steps you see here. This control panel gives you the flexibility to manage all of the moving parts that go into the valuation calculations in the income approach. You select the discounting convention, the assumptions that go into residual or terminal value, the long-term growth rate, and the excess earnings capitalization rate. In addition, you select an option for developing discount rates. One interesting thing to note is that BVS gives you the flexibility to select a terminal year that's different from the last year of your projections, which can be up to 10 years. Now let's take a look at the discount and cap rates. Here's where we develop the discount rate and capitalization rate to apply to the selected benefit stream. The elements of this screen will vary based on the discount rate method option you selected in the last control panel screen. Only those elements that are appropriate to the selected rate are displayed. The choices were build-up, CAPM, or manual user-defined. Again, you have the flexibility of choice. Notice that there are plenty of open line items for you to input any risk factors that should be included in the discount rate. The beta for CAPM can be derived from the company betas that might be included in the guideline public company method or in the section devoted to betas, where you can input company, index, or industry beta data and then select the one you want to flow forward into the CAPM method. Okay, here is where the discount rate for future earnings is converted into a capitalization rate for historic earnings. BVS performs this conversion automatically for you. If you've selected a debt-free benefit stream in the benefit stream control panel, BVS is designed to recognize this and apply the proper debt-free rates in the valuation methods. The discount rate and capitalization rate from the last screen are converted here into their debt-free equivalents. BVS gives you the flexibility to control the composition of debt and equity based on the existing capital structure or an alternate capital structure that you specify. This view is based upon the existing capital structure. If you had selected an alternate capital structure, the inputs would have appeared over to the right that let you enter the percent of debt and equity under an alternate capital structure. Now we've worked our way back to the income approach methods: discounted cash flows and discounted future earnings, capitalization of earnings and capitalization of excess earnings, and multiple of discretionary earnings. On each schedule, you work to an indication of value. These value indications will flow forward to the conclusions of value, or you can blend them here in the approach level conclusions to arrive at a single conclusion of value for the income approach. You have control over all the key variables in the income approach. BVS ensures that your assumptions are properly applied and helps you arrive at sound indications of value for each method. Once you've completed the different methods in the income, asset, and market approaches, you're ready to bring them all together in the valuation conclusions. And that's the subject of our next session. See you there.